So what are the historical allusions back to the 70s and 2021 that have you believing that the Fed will misstep here?
Hi, Tyler, and thanks for having me on.
You're welcome.
I think when you look back to the 70s, obviously, and certainly at the start of this cycle, the Fed, and a lot of other people for that matter, focused in on the 70s because that was the last big inflation surge. But there are a lot of material differences. There are similarities, even in terms of the Middle East conflict. But when you go back to the 70s, we saw the oil price surge by a factor of about 17 times. So it was very sticky for a very long period of time. But when inflation got out of the bag this time, that was the reference point the Fed was using in terms of their past mistakes and the fact that they didn't get inflation under control. And this came after 2019, when they were also talking about the mistakes that they made during the global financial crisis, not easing quickly enough and then choking off the recovery, the jobless recovery, too early. So unfortunately, a lot of the times, Fed policy is a function of adjusting for prior mistakes. Now, we saw that in 2019 when, in fact, they were very impulsive in starting to cut rates and cut aggressively during COVID, as they said that they should do. But unfortunately, that was actually very successful. And the mistake then was that as we saw inflation rise, and in particularly, you saw 3-month annualized, 6-month annualized inflation rates, just as we're seeing the opposite now move up, the Fed, having been very successful in seeing the economy pick back up, the markets pick back up, employment pick back up, should absolutely have reined in much earlier. And ex-Fed member Bullard made those comments earlier this week. And therefore, as a consequence, where we sit today, when we see exactly the opposite, when we see, as was mentioned earlier, 3-month annualized, 6-month annualized rates coming down, when we see the bones of the employment report maybe not as strong as it would be thought to be from the unemployment rate, as we see a situation where nominal growth is falling, it's clear that interest rates are way too high now. They won't cut, obviously, this week. We've said that already. But they have everything in their arsenal to argue why they should cut in a preemptive fashion, because history clearly shows that when you wait too long, the impact of monetary policy changes takes time and you get caught behind the curve. And I think if the Fed does wait too long, they will get the same situation again.
So what I sense you're saying here is that higher for longer, that phrase, is sort of the new transitory, that inflation will be brief and unsustained. And the risk here, just as it was, I think you would probably argue, in the period of the transitory phase, is that they wait too long to take the appropriate action. And in that case, they allowed inflation to take hold at a greater level than it otherwise would. And in this case, it could be to slow the economy past the stall speed.
I think that's 100% right, Tyler. And they said that themselves. When they revisited monetary policy in 2019, they realized that being preemptive was very important in making sure that the least amount of damage was taking place. But we know they don't want to make the same mistake twice. The mistake they made in 2021 was not getting inflation under control. So it's not a level playing field. And they've said that themselves, so I don't think I'm saying anything new. They've said that at the margin, they would prefer to be too late rather than too early, which I think almost guarantees, unfortunately, that they will be too late.